IRAs are one of the simplest retirement tools out there, but they're also one of the most misunderstood. Today I'm going to break down traditional IRAs, Roth IRAs, and show you how even high earners can still use a backdoor Roth IRA to build tax-free wealth.
This is the LawyerFi Podcast, equipping lawyers and other high-income professionals to reach financial independence. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.
Welcome to the LawyerFi Podcast, where we equip lawyers and other high-income professionals with the tools to reach financial independence. I'm your host, Adam B. Cordover, and today we're diving into one of the cornerstones of retirement planning, the IRA. If you've ever felt like retirement planning was complicated, you're not alone. But here's the good news. IRAs are actually fairly straightforward once you understand the basics. And no matter where you are in your career, whether you're a young associate just starting out, a partner hitting your stride, or a lawyer nearing retirement, IRAs have a role to play in your financial plan. In this episode, we'll walk through what a traditional IRA is, what a Roth IRA is, how they're different, and why you might choose one over the other. I'll talk about strategies for maxing out your IRA each year because, in my view, every high-earning professional should aim to max it out. And then we'll spend some time on the Backdoor Roth IRA, a strategy that lets high earners who normally can't contribute directly to a Roth still get access to that incredible tax-free growth. So let's get started by talking about the basics. What exactly is an IRA, and why should you care? Technically, the IRS calls it an individual retirement arrangement. That's the formal name written into the tax code. But in common usage, and by almost every brokerage firm you'll ever deal with, it's known as an individual retirement account. An IRA is a personal retirement account that you open yourself. Now, unlike a 401k, it's not tied to your employer. Whether you're an associate at a firm, running your own practice, or even if you just have a side gig, you can still open and contribute to an IRA. For 2025, the contribution limit to an IRA is $7,000 if you're under age 50 and $8,000 if you're 50 or older. These limits aren't static. The IRS raises them periodically for inflation. And there are two main flavors of IRA, the traditional IRA and the Roth IRA. Both let you invest in stocks, bonds, mutual funds, and ETFs, but the way they each handle taxes is different. Here's how a traditional IRA works. You can always contribute if you have earned income, but whether those contributions are deductible on your taxes depends on two things: your income, and whether you or your spouse are covered by a workplace plan like a 401k. If neither of you has a workplace plan, your contribution is fully deductible no matter your income. But if you do have a workplace plan, the deductible begins to phase out once you hit certain income limits. Regardless of whether you get the deduction, the money still grows tax deferred, so you don't pay taxes on dividends, interest, or gains along the way. However, you pay ordinary income tax when you withdraw it in retirement. Now, the Roth IRA flips that script. You contribute after-tax dollars, so you receive no deduction today. But in return, your money grows tax-free, and your withdrawals in retirement are also tax-free, as long as you follow the rules. That means if your investments double, triple, or even grow tenfold, you'll never owe taxes on that growth. For high earners, that could mean hundreds of thousands growing completely tax-free over a career. So here's a simple way to remember it. Traditional IRA, savings now, pay taxes later. Roth IRA, pay taxes now, save on taxes later. So which should you choose? If you're eligible, Roth spacing is incredibly valuable because it grows tax-free forever, and also Roths don't have required minimum distributions. On the other hand, if you're in a high tax bracket today and really want the deduction, a traditional IRA may look more attractive, though, as I mentioned, many high earners with other retirement plans are phased out of that deduction anyways. Before we go further, let me pause with a practical aside. So, where do you actually open an IRA? Now, three of the biggest and most trusted providers are Fidelity, Vanguard, and Charles Schwab. I personally use Fidelity's IRA. That's because they offer a health savings account alongside IRAs, which makes it easy to consolidate. Additionally, unlike Charles Schwab, Fidelity allows you to buy fractional shares of ETFs, such as the VTI Total Stock Market Index Fund. Compared with Vanguard, Fidelity also has a reputation for stronger customer service, which has also been my personal experience. Now, that said, no provider is perfect. I did run into challenges recently attempting to help a divorce client retrieve account statements from the early 2010s outside of formal discovery processes. But still, any of these three, Fidelity, Vanguard, or Schwab, can work very well. The key is to open one, get invested, and then focus on making sure you max it out every single year. But here's the catch for high earners. You may find that you're locked out of contributing directly to a Roth IRA. Fortunately, there's a perfectly legal strategy that helps you get around that income limit, and that's exactly what we'll talk about next. If you're a high earner, you may have heard this frustrating line. Sorry, you make too much money to contribute directly to a Roth IRA. Now, the IRS sets income limits for direct Roth contributions, and once your adjusted gross income crosses those thresholds, you may think that the door to the Roth IRA is slammed shut. In 2025, the phase-out range for direct Roth IRA contributions is $150,000 to $165,000 for single filers and $236,000 to $246,000 for married filing jointly. Above the top of those ranges, you can't contribute directly. But here's the good news. There's a perfectly legal way to indirectly make Roth IRA contributions, and it's called the Backdoor Roth IRA. Despite its name, it's completely legitimate. It's simply a two-step process that Congress allows. Step one, you contribute money to a traditional IRA. For high earners, that contribution usually isn't deductible anyways, so you're putting in after-tax dollars. And it's probably best just to keep the contribution in cash for this step. On to step two. After the funds clear the traditional IRA, which may take a few days to a few weeks, you convert that contribution to a Roth IRA. Because you contributed after-tax money, the conversion itself usually doesn't create much of a tax bill, assuming you don't have other pre-tax IRA balances. And just like that, voila, you funded a Roth IRA even though your income was too high to qualify directly. And now you can invest in anything that the IRA offers. By the way, if you're looking for simple ways to invest, check out our prior episodes on the Total Stock Market Index Fund and Bond Index Fund. And keep an eye out for upcoming episodes on international index funds and other options. So that's why it's called the Backdoor Roth. You can't walk through the front door because of income limits, so you just use the back door that Congress left open. For high earners, this often is the best way to keep building IRA wealth each year. Now, a quick word of caution. The Backdoor Roth works best if you don't have any other pre-tax money in traditional, SEP, or simple IRAs. If you do, the IRS applies what's called the pro rata rule, which can complicate the taxes. We won't go too deep into that here, but it's something to be aware of and potentially discuss with a tax advisor if you think this situation applies to you. In other words, you have money in other pre-tax IRAs. So that's the workaround strategy. Now that we've talked about the Backdoor Roth IRA, let's get practical. Because whether you're using a traditional IRA or a Roth IRA, the real power comes when you consistently hit the maximum contribution every year. In 2025, the contribution limit is $7,000 if you're under age 50, and $8,000, by the way, if you're 50 or older. These amounts may seem small compared to what you can put into a 401k, but don't underestimate them. Year after year, those contributions can snowball into hundreds of thousands of dollars by the time you retire. So how do you actually make sure you get there? Let's break it down into real numbers so it feels manageable. If you're under age 50 and aiming for $7,000 a year, here's what it looks like spread out. If you break it down weekly, it's about $135. If you're doing it bi-weekly or 26 times a year, about $270. Semi-monthly or 24 times a year, about $292. And monthly, $583. If you're 50 or older and eligible to contribute $8,000 to your IRA, the math works out to weekly about $154, bi-weekly about $308, semi-monthly about $333, and monthly about $667. And here's the easiest way to adapt in the future. Whenever the IRS raises the limit, just take the new annual number, the new limit, and divide it by the number of pay or other periods you want to use. So for example, if you get paid bi-weekly, you get 26 paychecks a year. So you would divide the annual contribution limit by 26. A full table of 2025 contribution limits broken down by pay period will be included in the show notes for quick reference. And when it comes to actually making contributions, I see two main strategies. The first is to set up automatic contributions. This works especially well with a direct Roth IRA or traditional IRA. You just set up a transfer once a month or once a paycheck and let it run. It's a classic pay yourself first move. The money leaves your checking account before you can spend it, and your dollar cost averaging into the market without having to think about it. Now, the second strategy, and by the way, this is the one I personally use for the Backdoor Roth IRA, is to save up in advance for the next year's contribution. Every year, I automatically direct a portion of my paycheck into a high-yield savings account earmarked specifically for the following year's IRA. By the time the new year begins, I already have the full amount saved, and usually in January or February, I make the entire contribution at once and convert it. I like this method because it keeps the tax paperwork clean. One contribution, one conversion, and it ensures the money has been set aside well before I need it. Both approaches come back to the same principle. Make savings automatic and build habits that work for you. This is what James Clear talks about in his book Atomic Habits. Small, consistent actions that compound into big results over time. So which method fits your personality better? Steady monthly contributions or saving ahead and doing it all at once? If you make it a habit to max these out every year, you'll be amazed at how much progress you've made a decade or two down the line. Before we move on, I want to pause and bring up a few rules and pitfalls you should at least be aware of when it comes to IRAs. I won't go too deep into these here because this episode is meant more as a broad beginner's guide, but I do want to flag them so you know what's out there. The first is the early withdrawal penalty. If you pull money out of an IRA before age 59 and a half, there is a penalty with some limited exceptions. Things like certain medical expenses, qualified educational costs, or a first-time home purchase. But in general, this money is meant for retirement. And here I also want to add a quick aside. I highly recommend against spending money pre-retirement from your IRA unless it's a total emergency and absolutely necessary, even if you qualify for one of those penalty exceptions. Imagine putting away money for years, only to pull it out and lose decades of future compounding. Here's why that matters. The amount of money you can contribute to an IRA each year is limited. So if you take money out, you're not just losing the dollars, you're losing the opportunity for those funds to continue compounding in a tax-protected account. That's an important cost you can't get back. You're much better off keeping your IRA money invested and instead maintaining a dedicated emergency fund. By the way, I covered emergency funds in a prior episode, so make sure to check that out if you haven't yet done so. And in a future episode, we'll go much deeper into what Albert Einstein reportedly called the magic of compound interest. The second thing to know is required minimum distributions, or RMDs. Traditional IRAs require you to start taking money out once you reach age 73 under the Secure 2.0 Act. Roth IRAs, by contrast, don't have RMDs for the original owner. And Third, there are rules around inherited IRAs. The Secure Act changed these rules. In many cases, if you inherit an IRA, you now have to empty the account within 10 years. There are exceptions, depending on your relationship to the original owner, but the bottom line is the rules are more restrictive than they used to be. Finally, a quick note on tax paperwork. If you're doing something like a backdoor Roth IRA, it's important to file Form 8606 to report non-deductible contributions and conversions. And fortunately, this is pretty straightforward. Fidelity, Vanguard, Schwab, or whichever institution you use should send you the paperwork you need at tax time. And you can either fill out the form yourself or give it to your tax preparer. I have to say, I know from personal experience, it's simple enough that it shouldn't scare you away from doing a backdoor Roth IRA if that's the strategy that makes sense for you. Do any of these pitfalls surprise you? If so, believe it or not, that is a good thing. It means you're learning about them now instead of being caught off guard later. And again, I don't want you to feel bogged down with details right now. Think of this section as a signpost. Each of these topics could be its own episode, and we may cover them more deeply in the future. But for today, I just want you to know these rules exist, so you can avoid unpleasant surprises and know when to get professional advice. With that in mind, let's shift gears and compare IRAs with another retirement tool you're probably already familiar with, the 401k. We've spent this episode focused on traditional and Roth IRAs, and just to be clear, I'm not talking here about SEP IRAs, simple IRAs, or solo 401ks. Those might be important tools for business owners and the self-employed, but that's a different discussion for another day. For now, I want to zoom out and compare traditional and Roth IRAs with the 401 workplace retirement plan. At first glance, it may seem like these two accounts are in competition. After all, both are retirement accounts. Both offer tax advantages, both have rules around contributions and withdrawals, and both usually have traditional and Roth options. But the truth is, if you follow the general rules that we've discussed, you can and probably should contribute to both. At a high level, here's a big difference. Contribution limits. In 2025, a 401k lets an employee contribute up to $23,500 if you're under 50, or $31,000 if you're 50 or older, and that's the standard $7,500 catch-up match. Now, at a high level, here's the big difference. Contribution limits. In 2025, a 401k lets an employee contribute up to $23,500 if you're under 50, or $31,000 if you're 50 or older. That's the $7,500 catch-up. Many employers match contributions, and that's the closest thing to free money you'll ever get in investing. There are different and much higher employer contribution limits, which we'll discuss in a future episode. So why bother with an IRA at all? Flexibility. With a 401k, you're typically limited to the investment menu your employer provides, which may or may not be great. With an IRA, you have full control. You can choose stocks, bonds, mutual funds, ETFs, or whatever low-cost diversified strategy works best for you. And contributing to both allows you to sock away more money in tax-advantaged accounts. Ideally, in most cases, you're best off maxing out both your IRA and your 401k contribution limits if you can. The 401k gives you high contribution limits and potential employer matching. The IRA gives you flexibility, oftentimes less costly options, and control. Together, they make a strong 1-2 punch in building wealth for retirement. We'll cover 401ks in much more detail in a future episode, as well as health savings accounts as a stealth retirement plan. So now that we've looked at how IRAs stack up against 401ks, let's bring this down to earth with a few real-world examples of how professionals at different stages of their career might approach IRAs. First, imagine a young single associate at a small firm just starting out, earning less than the direct Roth IRA beginning phase-out limit of $150,000 a year. Because their income is below the limit, they're still eligible to contribute directly to a Roth IRA. So the best move here is usually to automate contributions and investments, basically set it and forget it, so that each pay period money flows into the Roth without having to think about it. Over the decades, the tax-free growth in a Roth will be a huge advantage. And here's the key. That's less than $300 a paycheck if they're paid twice a month. In other words, it's not out of reach if they start early and stay consistent. Now, let's move to a mid-career partner earning more than $165,000 a year. They're above the threshold for direct Roth contributions. For them, the Backdoor Roth IRA becomes essential. They might max out their 401k at work, but they still want Roth space. The solution is to make a non-deductible contribution to a traditional IRA and then convert it. That way, they continue to build tax-free retirement assets despite their income. Finally, consider a senior lawyer over age 55 at a firm without a 401k or other plan. With the catch-up contribution, they can put away $8,000 each year into an IRA. At this stage, the decision between traditional and Roth might depend on tax planning. If they expect lower taxes in retirement, they may lean towards traditional contributions if deductible, but many high earners in this age bracket still use the Backdoor Roth for its estate planning benefits. No required minimum distributions and the ability to leave tax-free money to heirs. And here's the motivational part. By this stage, decades of compounding are already working for them, but adding catch-up contributions can still move the needle in a meaningful way. These three examples show how IRAs can fit into your financial life at different stages of your career. Think about which strategy makes sense for you now, knowing that you can adjust as your income, tax situation, and retirement goals evolve. Here's what I hope you take away from today's episode. IRAs are simple, flexible tools that can make a massive difference in your long-term wealth. Whether you use a traditional IRA, a Roth IRA, or the Backdoor Roth strategy, the key is consistency. Keep contributing and ideally maxing them out year after year and let compounding do its work. And I'd love to hear your approach. Do you contribute a little with each paycheck, making it a steady habit, or do you save up ahead of time and max it out all at once like I do? Drop me a note in the comments or on the Lawyer Financial Independence Facebook page, as I'm always curious how other professionals make this work in their life. If you'd like to dig deeper, check out the show notes for today's episode. You'll find a contribution breakdown table by pay period, a note on my episode on emergency funds, and links to some of the resources we mentioned, including James Clear's Atomic Habits. Your future self will thank you for the IRA contributions you make today. And if you find this episode helpful, please like and subscribe, and please let others know about it. Over the next couple of episodes, we'll be examining total international stock index funds, as well as small cap value funds. Thanks for joining me on this episode of the LawyerFi Podcast. And remember, financial independence isn't just a dream. Now let's go achieve it. This episode of the LawyerFi Podcast is sponsored by Family Diplomacy, a collaborative law firm. If you are facing divorce in Florida and looking for a private, humane alternative to a courtroom battle such as collaborative divorce, give us a call at 813-443-0615 or visit us at familydiplomacy.com. We accept clients in every county in Florida, and we have offices by appointment in Tampa, St. Petersburg, and Sarasota. You are not alone. We can help.
This has been the LawyerFi Podcast. Visit our website and learn more at LawyerFi.com, including information about how to become a sponsor. Watch or listen to us on YouTube, Apple Podcasts, Spotify, and anywhere you get your podcasts from. You can also reach us on Facebook, Instagram, TikTok, and LinkedIn. LawyerFi is hosted by Adam B. Cordover and produced by Eric Sachs. Original music is by Jake Biller. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.